In this video, I will compare two very popular growth ETFs, which are SCHG and QQQ. As for QQQ, this fund has a smaller sibling called QQQM, which comes at a lower expense ratio. Right off the bat, we see that SCHG has a much lower expense ratio of 0.04% compared to QQQ or QQQM. Both SCHG and QQQ target the large cap growth area of the US stock market. US large cap stocks attract a lot of attention and are very liquid. They reflect new information in their stock prices very fast, and this is unlike their small cap growth counterparts, where mispricing can persist for a long time. But QQQ follows a large cap growth with a twist. It only includes the largest 100 stocks that trade on Nasdaq Stock Exchange. Some analysts point out that this is a flawed index strategy. It aims at promoting Nasdaq rather than a sound investment rationale. There's no selection or anything like this for QQQ. As long as a stock is trading on Nasdaq and its market cap is large enough to be in the top 100, that's it. It gets included in QQQ. Most of QQQ holdings are non-financial companies weighted by their market capitalization. Market cap weighting is a sensible approach for large growth stocks, and the reason is that it takes advantage of a market's collective wisdom, which, as we know, is very tough to beat. If a given stock underperforms, its market cap starts to shrink, and if the market cap goes down low enough, the QQQ may drop such stock, and it will replace this weaker company with a stronger one that shows better relative performance. Due to its limits to the Nasdaq universe, stocks like Oracle, Uber, or Salesforce are excluded by QQQ. But the good news is that QQQ is full of large cap growth names, such as the Magnificent Seven. If we look at the top 10 holdings, they are familiar faces with about 50% concentration. By the way, most of the information in this video comes from Seeking Alpha. It's a great platform to research stocks and ETFs. I partner up with them, so check them out with links in the description. As expected, QQQ is heavily tilted to the tech sector with roughly 52% exposure. The second largest exposure of about 15% goes to the communication services sector. This is where Meta, Alphabet, and Netflix reside. There's also some exposure to consumer cyclical and healthcare sector, as we see here. One thing that I want to point out is that QQQ changed its policy in July of 2023. Specifically, they are now allowed to rebalance their portfolio to avoid excessive concentration at the top. For instance, in 2023, they rebalanced their portfolio and reduced the top 7 holdings concentration from 55% to 43%. Now, let's circle back to SCHG. This fund is a different animal compared to QQQ. It tracks the performance of the Dow Jones US Large Cap Growth Total Stock Market Index. Here's what SCHG does to select its holdings. It takes 750 largest stocks and then ranks them based on various growth metrics. Among them are projected price-earnings ratio, projected earnings growth, price-book ratio, dividend yield, trailing revenue growth, and trailing earnings growth. After that, it selects the top 200 to 250 stocks weighted by the market capitalization. When we look at the top 10 holdings, they are somewhat similar to QQQ for the first 7 or so stocks. After that, these ETFs begin to diverge. This is mainly because SCHG considers all stocks, not only those trading on Nasdaq. I think that's a very strong advantage in favor of SCHG, of course, along with its low expense ratio. In fact, if we compare SCHG and QQQ's turnover ratios, QQQ has a ratio of 8%, which is of course low as it is, but SCHG's turnover ratio is 3%. So it can partly explain why SCHG can charge lower expense ratio, because it doesn't have to trade that often, along with some other factors. As for the sector exposure, QQQ and SCHG are similar with tech dominating. One key difference between the two is the number of holdings. QQQ includes 100 stocks, while SCHG has over 200 stocks. While their top 10 concentration is similar, SCHG is much better diversified due to more holdings. If diversification is important for you, then SCHG clearly wins here. True, QQQ's higher concentration resulted in higher returns for it, as we will see in a second. But high concentration goes both ways, and it amplifies gains and losses too. SCHG has a higher relative value metrics like price to earnings or price to book ratios. While it may seem like a bad thing, we have to look at it in a broader context. Namely, SCHG's portfolio commands higher returns and sales growth rates. This probably justifies higher relative valuation numbers. Next is historic performance. And here, guys, QQQ beats SCHG hands down. True, the performance difference on an annual basis was within 2.5%, but it has been more than enough for QQQ to smoke SCHG long term. For instance, here's the total return chart since December 2009 when SCHG got released. We see that the cumulative performance difference is huge. As for the Sharpe ratio, QQQ looks more attractive on a long-term horizon of 10 years. Its Sharpe ratio was much higher than that of SCHG, although in the last 3 years SCHG did better than QQQ. As for the drawdowns, both SCHG and QQQ showed a similar picture during the last drawdown of 2022. So it looks like that based on historic performance and volatility, QQQ did better. The thing is that SCHG and QQQ don't have one-for-one overlap. If we look at their composition, only 63% of their holdings by weight overlaps. The remainder is either different stocks or different weighting of the same stocks. Of course, what we see here is a snapshot at a given time, but these numbers fluctuate. If we look at the top 5 holdings, for instance, SCHG and QQQ weights them differently. SCHG overweights all of them. So these differences explain total return divergence between the two. So which fund will suit growth investors' needs best? To answer this question, let's compare these funds with their features one by one. First is expense ratio, and SCHG's 0.04% ratio is extremely low and lower in comparison to QQQ or QQQM. True, the difference is not that much, about 1.1 or 1.15%. But still, this difference compounds over time. Next, it's exposure to growth stocks. And here, QQQ's exclusion of anything that doesn't trade on Nasdaq Stock Exchange doesn't make it a very good fit in this respect. It's somewhat arbitrary. Conversely, SCHG looks at all corners of the stock market and includes stocks that QQQ excludes by its design. Moreover, SCHG screens even further its holdings by some of the forward-looking metrics such as forward PE or expected growth rates. So, in a sense, SCHG provides a better and more consistent exposure to growth stocks compared to QQQ. At the same time, QQQ's superiority when it comes to historical total returns is undeniable. Exposure to 100 largest Nasdaq stocks along with higher concentration allowed QQQ to outperform SCHG. Of course, past performance does not guarantee future returns, and with that, QQQ may or may not continue outperforming SCHG. And as we saw over the last 3 years, they were both neck and neck. So performance-wise, it's forward-looking and is very hard to assess unless we have a crystal ball. Overall, both funds are terrific options for investors looking to get exposure to growth. One concern for both funds is their top-heavy concentration. Their top 10 holdings account for roughly 50%, which could be a concern for someone, so it's something to keep in mind. There's more that I talk about than ETF analysis on this channel weekly, so be sure to subscribe and I will see you next time. All the best!